Alright, what's happening investors? Max Keswick here. In today's video we're going to be talking about why do I prefer high growth stocks and rental properties to dividend investing, stock market, index funds investing and ETFs, bonds, things like that. First reason guys is growth. When you're young, all you should be concerned about is how much your portfolio can grow into the future. And that's where you can take big amounts of risk. You shouldn't be well diversified and, thinking about, I don't want to take too much risk, blah, 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 because you're never going to get rich. The first thing is you want to get as rich as you possibly can when you're young. And when you're older, you want to preserve wealth. When you concentrate, you build wealth. When you diversify, you keep wealth. And that should be your motto. So now we're going to look at, where you can put your money and how it would perform over, let's say, 1 year. I always preach long-term investing, but let's just do what if you put your money here, blah, blah, and what's going to happen in 1 year's time. Okay, so let's say you've been saving really, really hard, you've been working long hours and you finally got your first £10,000. What do you do with it? Okay, so number one, let's say that you keep this money into, you put this money into a savings account. Nowadays, guys, the rates have gone down quite dramatically. So all you'll be getting is about 0.6%, if that, if you're lucky. So let's say you're getting that. That is £60 at the end of the year. So that 10 grand stays there the whole year. You get £60 at the end of it. Congratulations, you are now very, very rich. You can go to Asda and buy yourself a weekly shop. Now, let's say you're a little bit smarter than that and you say, you know what, I want a little bit more growth. So you're gonna put that £10,000 into an S&P 500 fund, which is an index fund that basically tracks 500 largest companies in the US. And usually that fund grows at about 7% every single year. Now, some years that fund might go up like 30% and some years it might go down like -3%. But over the long term, 10 to 20 years, you're gonna get an average of around 7% of annual growth. So that is now leaving you with £700 of profit. Not bad. You're still getting a little bit of money at the end of it. Certainly a lot more than if you just put that money into your savings account. But it's not money that is life-changing for most people. That is basically like an extra monthly payment for your rent. Okay, so now let's say that you like dividend investing and you're gonna choose an AT&T stock, which is like ridiculous yield of 7%. I believe it's like 6.9 at the moment. The share price is about 29, just over $29 per share, and it usually stays there like the whole time. Like literally, guys, I bought some AT&T like in March time, I believe. Last year, and I've got like my dividend and all of that stuff, but it literally stayed the same. Like this stock does not move. It just stays stagnant the whole time. It's very rare that you might, grow, that you might actually make some money on the share price because it just stays the same. And that's why people buy it. So it's like, you park your money there, they pay you 7% per year. So with AT&T, with any dividend stock, you get paid quarterly. So 4 times per year, and you're gonna get paid 7%, which is the yield on that stock. So again, if you put in £10,000, you're gonna get around £700 worth of dividends. Now that is if the company is profitable and if they will not suspend the dividends. Some companies, when we had the crash, actually suspended dividends for, they can do it for 3, 6 months, 12 months. You don't know how long it might be. But usually if it's a good company, if it's stable, they will pay your dividend. So that is another way of investing. Now, let's say that you want to put your 10 grand into one single stock because you feel like you want to get the most out of, the growth of your portfolio. And let's say you choose Tesla stock. So now over the next year, let's predict that you're going to get around, 20% return on your investment. Now, people are saying 20%. I can make easily 50 to 100% per year. Look at Tesla. went up over 1,000% year to date. You know, other penny stocks went up 2, 3, 4,000%. Now, you have to keep in mind, guys, that we're in a bull market right now. We had that crash, and if you bought at the dip, even the S&P right now, it's up 70% last year. Remember how I said that S&P usually goes up about 7% year over year? Yes, sometimes it goes up 70%, some years it actually goes down, and some years it just does like, 2 or 3%. But on the average, it goes up about 7%. You're never gonna get those returns every single year. Just because we had a very good year this year, people get too comfortable and too confident, and that's where they start to actually gamble, think they know what to do in the stock market, and then we have a correction and people lose their money. Now, the greatest investor, Warren Buffett, gets about 20% return per year throughout his whole career. Do you really think you can beat the greatest investor of all time? So I'm being very generous when I say that 20% year over year return, at least till 2030 in a Tesla stock, is possible. Because we're in an age now where, innovation is very, very popular. A lot of people want to invest in innovation, and unfortunately, other companies will lose. And the same goes for Apple, how it was very profitable for the last 10 years. Now it's more of a cash park where you just put your money to let it sit for a while, but it's not going to give you high growth returns anymore, whereas Tesla has so much more growth ahead of itself. If you think that Tesla is going to do another 1,000% from here, the next year, that's delusional. That's not going to happen. That is definitely not going to happen. So let's just say that you're getting that 20%, which is quite good in the stock market. So let's just say, for the sake of argument, that £10,000 at 20% is £2,000. You're £2,000 in profit in that 1 year. That is pretty good, right? What about if you put that 10 grand into real estate? So now you put that 10 grand of the deposit and you bought a house for 200k, right? You bought the house. Houses usually grow at the rate of 3.5% per year. So last year we had pretty massive growth of around 6 to 7% in the housing market. But keep in mind that it's not going to be happening every single year. Just like the stock market is not going to just keep on going up and up and up. We will have a pullback. Now, we had budget in March in the UK, and what was said was that, we're going to have 5% deposits coming back to the UK from April. So that again is going to raise prices. A lot more people will be buying houses. Also, the stamp duty has been reduced and furlough has been extended. So we're not going to see a pullback, I think, until the end of the year, if not the next year. And we're not going to have a crash, guys. It's never going to be as bad as 2008. We will have a slight pullback, I think 10 to 15%. Should that stop you from getting into the housing market right now? It shouldn't. So let's say that you would buy that house at 3.5% for the next year. That is 7 grand in profit. Now, have a look at that. So you actually had lower percentage gain, but here's the kicker, guys. We're using leverage, and that's exactly what you need. Now, you could argue that you can use leverage in stocks as well, which is margin. So let's say you have 10 grand, they will give you another 10 grand, and let's say you invest that into the Tesla stock. Now, that stock drops. You never predicted the stock is going to go up, down, sideways. So let's say if it goes down, you get a margin call. If you don't deposit more money into your account, they will sell other positions. They will want your money. They will sell other positions to cover themselves, or they will just sell out of your stock straight away. Now, with a house, that doesn't happen. So this is why I don't like to use margin on stocks. I never used margin in the past, and I'm not planning to. Margin is good to use. Let's say if you have, loads and loads of money, guys, like over millions, and the stock crashes, and this is where you should use margin, not when it's like at all-time highs, because then you can actually make a lot more money. But that's another topic for another video. Now with houses, guys, is different. You get a loan, you get a mortgage, and let's say that the housing market crash, and now your house is worth a lot less than what you bought it for. Now, as long as you have money to keep paying for that house. So let's say if it was an investment, as long as you have a tenant in there paying you rent, you're fine. If you can't find a tenant, just lower your price. Let's say you lower your price to like £50 or like £100. People will come in and they will rent your house. Like, people are so concerned with this, where they're like, oh, what if I can't find a tenant? It's like, well, first of all, if you don't own a house, get the first house so you can live with it, so you can pay your rent. I just don't understand that. But like, people say, oh no, I don't want to buy a house because I'm not going to be able to make those payments. It's like, well, you've paid for your rent all until now. So how are you not going to be able to pay for your own house? It's like, you still have to pay rent. So you have to just figure out and go to work and find work and like pay for your mortgage. So now let's just say that the housing market has crashed and your house is worth less. You won't get a phone call from your bank saying, hey, the price is obviously going down, you have to pay up. Because as long as you're paying your mortgage, you're fine. Whereas from a broker, you will get a phone call straight away saying, listen, pay up, you got 2-3 days because we will sell your stocks. So this is why, using leverage is so good early on to build wealth. Now, what I haven't included in the house, guys, is cash flow. So even though you live in it yourself, you're still paying for someone else's rent, right? So you're paying, let's say, £600. So let's say for 200k, we can get a 2-bedroom flat. I live in one room, I rent the other room out. So let's say my rent, in this flat right here is just over £600 per month. So let's say I'm making already that 600 I'm putting into my own equity in the house. And let's be generous, so let's say that I'm gonna rent my other room for £400, which is like dirt cheap. So now I'm making £1,000 per month, right? Of extra money, basically, because I'm not just giving away to some landlord, I'm putting that into my own house, which later on I can take that money out, that equity that is in the house, and put it into the next house. More on that later. So now we're looking at over £12,000 profit of just cash flow per year. That with the £7,000 gain if the house prices will go up just by 3.5%, is £19,000. That's the difference, guys. You would have to actually make over 200% in Tesla stock just to match what I just did with the house. So yes, of course, guys, if we have another massive stock market crash and you see those stocks that you really like, you could make that much money, but there was a lot more risk involved in that. Now, back in the day when I first got into Tesla stock in June 2020, when it was still very cheap, that was a good time to get in. So anytime we have a massive stock market crash, you can put it into high growth stocks. But again, you have a lot more risk involved in that. What if that company fails? Back in the day, guys, when I was investing in Tesla, it wasn't even profitable. They weren't even making profits. So there was a lot more risk involved in that. But now, like, everyone wants to invest in Tesla because they feel like, the stock is going to do the same that it did last year. That's simply not true. And again, guys, in the stock market, there is a lot more risk involved, especially now where we are at all-time highs. So it's like, where do you go from here, guys? Like, some of these stocks out there have evaluations like stretched out to the max. Like, where do you go from here? So this is why I prefer to use leverage to my advantage and buy myself a property at a very low risk involved. You can't even compare that to the stock market and make a lot more money that way and build my wealth that way. Now, the only issue with properties is that you have to have a bigger deposit, and most people don't have that. So what should you do? Now, the safest way is to just save the money. What I've done is a little bit more risky. So what I've done is I've invested the money into crypto and certain stocks. So let's say my best performing stocks were Upwork and Tesla. I've sold a little bit of those stocks once they went up, like I think they did 2 to 3x for me. So the thing is with stocks, guys, you have to research the company. You have to understand the company on a high level before you even invest in it, because if it goes down, you might freak out basically, and you're not gonna see that as a buying opportunity because you haven't actually researched it correctly. But now with the houses, guys, is that you have to also make sure you buy on the market value. So if you buy a house that is worth a lot less for more, you're losing money, on the start. So the money in real estate is made when you make a purchase, and then the next thing is cash flow, and then capital gains over time that you make on that, on the value of the house. So what I've basically done is I took a very high risk approach into getting my first deposit a lot quicker than if I just saved the money. But also it could have ended the other way, where let's say we had a massive crash, I've lost money, and then I had to take it out for the deposit because that's the only money I had, and then it could have ended badly. So you have to always take that into consideration. The best thing to do really is, you can invest a little bit into some of those stocks just to participate and learn about the stock market, but keep majority of your money in cash and buy yourself a property, because most likely you'll make a lot more money that way, especially in this year and the years coming ahead. Now, we're not going to see those massive returns in stocks, unfortunately, guys. People think that we're just going to keep going up forever. This doesn't happen, all the time. And the thing is with most new investors, guys, we had a lot of new guys come in March when the crash started. Now I've started investing in summer 2019, so that was way before the crash. So I've been through the crash. I've seen my portfolio basically went down like 30-something%. So I've been through that. I held, I bought more, whereas most people haven't been through an actual crash. So, they see a small pullback and they, freak out and they just sell. So that's why I believe people should still be in the stock market. But I think that you can make, use that leverage while you can, get to the 5, 10, 20 properties. And at that point, it kind of makes more sense to then invest in stocks because the amounts are so much higher. And once you get to that point, then it kind of makes more sense. Let's say if you put in like $1 million into a Tesla stock or something like that, even a few percentages will make you like so much more money. It just doesn't make sense to keep buying loads of different properties which you will have to manage. My main focus and my investment strategy is to basically concentrate, build as much wealth as I can to the age of 40 or 50 years old, and then I can diversify and then maybe have some dividend stocks, some index funds, loads of properties, and be well diversified and have my cash flow and live off of that comfortably. But until that point comes, guys, you're not gonna get there with investing in an index fund or dividend stocks. It's gonna take you so much longer, and we're not here forever, guys. I hope this video made sense, guys. If you made it to the end, make sure to smash the like button. It really helps my channel grow. Comment down below, let me know your thoughts on dividend investing versus growth stocks versus real estate. What do you like best, especially when you're starting out? Subscribe if you haven't already, guys. Smash the notification bell so you are notified every single time I post a new video. And we'll see you guys in the next one. Peace.